For years, streaming services like Netflix, Hulu, and Amazon Prime have been offering consumers endless entertainment at relatively low costs. But now it seems the golden age of cheap streaming is coming to an end. What happened to the era where we could binge watch our favorite shows without breaking the bank? This is the story of how and why streaming prices are skyrocketing. To understand why this is happening, we need to look back to the early 2010s, when streaming was a new disruptive force in the entertainment industry. At that time, Netflix transitioned from a DVD rental service to a streaming giant, offering a vast library of movies and TV shows for a fraction of the cost of traditional cable. Competitors like Hulu and Amazon Prime quickly followed suit, leading to a streaming boom. Consumers flocked to these services, enticed by the low monthly fees and the promise of cutting the cord from expensive cable packages. However, the landscape has drastically changed in the last few years. The streaming market is now saturated with a plethora of new entrants, including Disney+, HBO Max, Apple TV+, and Peacock. Each of these platforms has invested heavily in creating exclusive content to attract subscribers, but producing high-quality original content comes at a steep price. For instance, Disney spent over $100 million on their series The Mandalorian, and Netflix invested a staggering $200 million in the movie The Irishman. These massive investments have led to a significant increase in operating costs for streaming services. To cover these expenses, streaming platforms have begun raising their subscription prices. Moreover, the competition for exclusive content has intensified. Licensing deals for popular shows and movies have become more expensive as platforms vie for must-have content to draw in subscribers. Shows that were once staples on Netflix, like Friends and The Office, have been pulled by their parent companies to bolster their own streaming services. This content fragmentation forces consumers to subscribe to multiple platforms to access their favorite shows, leading to higher overall costs. The pandemic also played a role in accelerating this trend. With movie theaters closed and traditional TV production halted, streaming services became the primary source of new entertainment. This surge in demand highlighted the value of streaming platforms, giving them leverage to increase prices without losing subscribers. But it's not just about content costs. The infrastructure needed to support streaming servers, bandwidth, and technology development is also expensive. As streaming quality improves, with 4K and HDR becoming the standard, these costs continue to rise. Streaming platforms are also investing heavily in personalized content recommendation algorithms, user interface enhancements, and customer service, all of which add to operational expenses. Consumers are feeling the pinch. According to a survey, the average household now subscribes to 4 different streaming services, spending more than $50 a month on streaming alone. This figure is rapidly approaching the cost of traditional cable packages, which many cut the cord to avoid in the first place. As each platform continues to raise its prices, consumers are finding it harder to justify the combined cost. Let's delve deeper into the specific factors driving up the costs of streaming services. Content creation and acquisition. The race to create exclusive, original content is perhaps the most significant factor driving up the costs. Netflix, for example, spent $17 billion on content in 2021 alone, with plans to increase this budget in the coming years. This includes not only blockbuster films and TV series, but also documentaries, stand-up specials, and international content. The strategy is clear. Unique, high-quality content attracts and retains subscribers. However, the financial burden of these productions is immense. Licensing and rights. The bidding wars for existing content have become fierce. Popular shows like Friends, The Office, and Seinfeld have been subject to massive bidding wars, with networks paying hundreds of millions to secure the streaming rights. These costs are inevitably passed on to consumers. Additionally, as more content creators pull their shows from Netflix to bolster their own streaming platforms, Netflix and others are forced to spend even more on acquiring or creating new content to fill the void. Technological investments. Streaming in high definition, 4K and HDR, requires significant investment in technology. This includes upgrading server capabilities, improving bandwidth, and enhancing streaming infrastructure to ensure smooth, high-quality viewing experiences. Moreover, advanced algorithms for content recommendation and personalized user experiences demand continuous technological innovation and investment. Global expansion. As streaming platforms expand globally, they incur additional costs related to regional content production, localization, and compliance with diverse regulatory environments. Producing content that appeals to different cultural preferences requires significant investment, but it's essential for attracting a global subscriber base. Market saturation and competition. The entry of numerous new players into the streaming market has led to intense competition. Platforms are not just competing on content, but also on pricing, features, and user experience. This competitive landscape means that to stay ahead, companies must continually invest heavily in all aspects of their service, driving up operational costs. Pandemic-driven changes. The COVID-19 pandemic caused a surge in demand for streaming as people stayed home. This led to increased investments in content to meet the higher viewership and maintain subscriber growth. However, the pandemic also disrupted production schedules, causing delays and increasing production costs. Let's take a closer look at some of the streaming giants to illustrate these points. Netflix. Netflix's rise to dominance was built on its vast and varied content library offered at an affordable price. However, its heavy investment in original content, such as Stranger Things, The Crown, and countless other series and movies, has necessitated price hikes. Netflix has increased its subscription prices multiple times over the past few years to sustain its massive content budget and technological infrastructure. Disney Plus. Disney Plus entered the market with an extensive library of beloved classics and blockbuster franchises like Marvel and Star Wars. The service quickly amassed subscribers by leveraging this content. However, to maintain and grow its subscriber base, Disney Plus has had to invest heavily in new original content, driving up costs. Shows like WandaVision and The Mandalorian come with hefty production budgets, reflected in recent price increases. HBO Max. Known for high-quality original content like Game of Thrones and Westworld, HBO Max has positioned itself as a premium streaming service. Its pricing reflects this premium positioning, but to compete with other services, HBO Max also needs to continually invest in exclusive content and technological improvements. So, is the era of cheap streaming over for good? It certainly seems so. As platforms continue to invest in exclusive content and technological advancements, these costs will inevitably be passed on to consumers. The streaming market, once a haven for affordable entertainment, is becoming just as costly and fragmented as the cable TV it aimed to replace. For consumers, this means making tough choices about which services to keep and which to let go. Bundling services, seeking out promotional deals, and being selective about subscriptions are strategies many are adopting to manage costs. In the future, we might see further consolidation in the industry as companies merge to pool resources and content libraries. Alternatively, the emergence of ad-supported tiers, as we have seen with some platforms, could offer a lower-cost option for consumers willing to watch ads in exchange for a reduced subscription fee. Ultimately, the streaming landscape is evolving, and the days of cheap, all-you-can-watch entertainment are likely behind us. As companies strive to balance quality and cost, consumers will need to navigate this new reality and find the best way to enjoy their favorite content without breaking the bank. Thank you for watching. If you liked this video, subscribe to Luxe Lane and check out some of our other content.